let's welcome Doug Duncan.
Thank you, David. Great to be here. I was recently introduced as the extinguished economist from Fannie Mae, so it's particularly good to be here in light of the lack of extinguishment. I actually live in Florida. I work in D.C., so we moved to Florida about 5 years ago. And you can tell our children are being raised by an economist because they call it God's waiting room. No sense of emotion whatsoever, no feelings. We love it. We live in Cape Coral, about an hour and a half south of here. We bought in September of 2010. My professional reputation as the chairman of the Fannie Mae House Price Forecast Committee required that I hit the bottom on prices. So, the 3 rules of forecasting: if you give a number, don't give a date. If you give a date, don't give a number. And if you get it right, don't look surprised. So I want to thank David, and I know Bob is here. Bob Eisenbeis, the whole team at Cumberland. Bob's got, I think, about 5 references to his research work in my PhD dissertation. I don't know if you knew that or not, but it's been a great time getting to know the folks. We like the area in the state, so happy to be here. Florida is significant in that it's one of 3 states which make up 30% of the entire U.S. housing market. Texas, California, and Florida are 30% of the housing market. And California is the largest of the 3 in terms of total value of housing, but I think Florida is second. And there are some price differentials between the states. But that makes it an important place to be from a housing perspective. The title I have here is the title that when they asked me to speak, they said pick a title. So I picked the title Housing in Context. My intention is to talk about the macroeconomic setting, maybe 10, 15 minutes, the housing market, and then policy issues related to housing. So to put it in the context of the background economics and what has or has not happened or might happen in the policy arena, to give a feel for how we think housing will perform over time. So it's not Florida specific. If you were looking for a forecast, I left out front a page where I copied 6 Dilbert cartoons. I'm a big fan of Dilbert, and he did 6 days of macroeconomic forecasting where, does anybody read Dilbert? So you know Wally, the little guy with the 2 sprigs of hair. He made up a bunch of gibberish, and then he picked a number, and he got it right. So then the CEO turned to him as the expert. And it kind of captures the difficulty of macro forecasting. In addition to my slides being available, if you read such things, the Journal of Structured Finance, which is a professional practitioner's journal, is doing a special issue on mortgage and real estate, and they asked me to write the opening paper for that. It's about 15 pages long, lots of charts, but it's intended to focus much more closely on the broad-based housing piece of things with less policy and macroeconomics in it. That will be out sometime within the next couple of months, to the extent that you're looking for a written document. What I'm going to say here tonight is a piece of that, so you get a preview of that. But I'm going to talk about the economy, housing broadly, and then policy. Our theme for the year at Fannie Mae in our macro forecasting space, in December we sit the staff down and look at where we got the forecast wrong in the previous year, what trends we missed, or what data points that we missed, and then try to discern what's likely to be the dominant driver or the dominant theme for the upcoming years. So this year, well placed in light of some of the newspaper and public discussion in Sarasota in the last couple of days, our theme is housing affordability constrains as the expansion matures. So there's 2 pieces of information there. The latter part of that statement is intended to point out that we're now in the fourth longest economic expansion since World War II. And in our monthly surveys of 1,000 people across the country, it's still the case that 57% of the public feels the economy is on the wrong track. And they've essentially never thought we were on the right track during that entire time frame. From our way of thinking, you're seeing that in the presidential election campaign. Lots of dissatisfaction all across the political spectrum with the way the economy has progressed in this expansion. But we wanted to point that out to suggest to people, I don't believe that the business cycle has been repealed. So the longest expansion that we've had is 10 years, and that's about 3 years from now. So if you don't believe the business cycle has been repealed, you might be thinking from a risk management perspective of what will be the way that you'll manage your resources in the course of a recession, which we think may happen. Although our models are just like most other folks, they don't show a recession in that time period. Certainly the central bank is taking actions they think will prevent, to the extent they can control that, prevent it. But from our perspective, we thought it would be useful to think about that from a risk management perspective. The first part, housing affordability constraints, I'll talk about a great deal today. But for those who are looking for a forecast beyond Dilbert, I'll give you the 2-minute forecast. We think, excuse me, we think the economy will grow 2% this year. I think our actual forecast is 1.9%, but economists tend to put decimal points in their forecast to demonstrate their sense of humor. We think unemployment will end the year at about 4.7%, a little bit down from where we are. We have in our forecast one move by the Fed. We have that move in September. And we think home sales nationally will be up about 3%. And we think mortgage rates at the end of the year will be where they are today. So we see very little movement. Actually, all out through 2017, we don't see much movement in the mortgage arena. And recently, very interesting little sidelight before I turn to the slides. We had anticipated that households who had refinanced at 3.75% had locked in those fixed rate mortgages of somewhere between 15 and 30 years duration, never again to take another mortgage. As it turns out, because house prices have been increasing at between 5 and 6% for the last 5 years, and interest rates haven't gone anywhere, there has been a recent pickup in cash-out refinancing in the marketplace. So those folks are saying, well, now that we've seen 15 or 20% appreciation in the value of our house, and interest rates are still the same, maybe we'll take some of that out. Hopefully that's not an early sign of poor financial management. We'll see how that plays out over time. So with that, let me move ahead, see if I can make the... Do I point back there? There. That basically says Fannie Mae will deny I was ever here. So here's our agenda. We're going to talk a little bit about the U.S. economy. The outlook has some elements of strength, but it also has some drawbacks. I'll point out a couple of those. The housing market has good long-term potential. I'm actually quite optimistic because the U.S. has one of the best, if not the best, demographic profile in the developed world. But there are the folks who are making claims that it's back to normal. I think I'll show you some data that will disabuse you of that view. And I do want to talk about the lack of a definition of housing policy objectives, and I'm suggesting you're not going to see much clarity on that in the near term. So what about the U.S. outlook? As I said, demographics are favorable. Employment has picked up. In some sense, it's normal if you look at unemployment rates, but there are some other aspects of that to consider. Current low rates are holding down the debt burden, both of individuals and of our federal fiscal situation. There are some drawbacks. First of all, productivity gains have been very weak, and that has meant income growth has been very weak. That's part of the affordability constraint question. Fiscal policy is basically absent as an influence, and monetary policy is overextended in our view and is creating some distortions and we would like to see some normalization. So here's a picture of our demographics. This is a histogram. Here's the baby boomers, men and women. You see the size of the cohort is actually pretty similar to the millennials. So there's been lots of discussion about the millennials. They will actually be the largest demographic group that we will ever have had, larger than the boomers. So there are some misconceptions about their behavior, just as there were misconceptions about the boomers. So 10 years ago, you read a bunch of articles. The boomers like to party the night away, so when the kids move out, they're going to buy condos downtown and party the night away. I tell people that the evidence from Cape Coral is if you want a good restaurant reservation, wait till about 7:30. So what happened was people saw some of the leading edge of the boomers doing that, but there's such a large population group relative to their parents that proportionally no more of them were undertaking that action than were of their parents. But because of the numbers, the share in that tail of that distribution was much larger, so people were seeing more boomers doing that than their parents. But from a behavioral perspective, they were no different. The same interpretation is being made of the behavior of millennials. The argument is millennials want to buy or rent 300 square foot apartments downtown, which have great amenities, and yes, many of them are doing that. But if you look at their aspirations and what they're actually doing when they're forming households, they're actually just like their parents. Maybe a shade more conservative in going into the housing space, but it's because there are even more of them than there were of the boomers. So people are making an interpretation that there's a change in behavior, which is actually only statistical evidence of the size of them as a group. Does that make sense? Okay, so you have to be really careful how you interpret that. The 90% plus of the millennials we survey say they eventually want to own a home. The key is eventually. So this is the shortfall of household formation in the first half of this decade. Significant impact on household formation from the magnitude of this downturn. So it looks like the 2015 evidence going forward looks like we will get back somewhere close to normal, but what that means is there's some catch-up that will need to be done, most likely in the first half of the next decade if household formation behaviors for each population cohort are similar. So that's part of the reason that I suggest I'm actually optimistic about housing. I mean, it's always been the case, excuse me, that people live in a building built on land somewhere in proximity to where they work in a building built on land, and it will always be that way. It's sort of like accounting. Every business needs accounting. Housing, there's always needs to be a place to put your people. That's why it's in every developed country a part of social policy. We'll get to the policy piece a little bit later. So demographics, very favorable for housing going forward. Statistical tricks economists always use. So the statistical trick here is I've truncated the workforce between the ages of 25 and 64. So I want to capture people who are really in the prime working age. You might say 62 to 64. Some folks took early retirement, so maybe I've overstated it a little bit. But unemployment in that age group down to about 4%. So pretty close to full employment from that measure. But up here, what you see is the decline in the workforce participation from that age group. When you would think they would still be working, significant decline. And two things are going on there. One is the workforce participation by working age men has been in decline some 20 to 30 years. But it wasn't revealed until workforce participation by women peaked in 2000 and also started to decline. Then it was revealed that that's been underway in working age men for some time. A variety of arguments about that. If you want to talk about that in the Q&A time frame, we can do that. Related to that affordability constraint, one piece I said was going to be income. Income growth comes from productivity gains. Real labor productivity gains have been slowing. There's been a fair amount of discussion among economists about that, but if you look at the relationship between long-term real income growth. This is the 10-year rolling average of income growth, and you look at its relationship to productivity, very tight relationship between the growth of productivity and incomes. And productivity gains have been exceedingly weak in this expansion. Typically what happens is businesses invest in plant and equipment, which improves the tools that their workers have to work with, which increases the productivity of those workers, which allows them to increase real incomes for their workers. That has not worked well at all in this expansion. If you look at the share of income that goes to workers, that's actually been in a gradual decline since the early 1960s, but it accelerated significantly starting in about 2005. Again, not fully understood by economists, but certainly a source of worry, and one of those things that's running underneath as an undercurrent in the public in the discussions that you're hearing about income growth and income distribution. Now, I said that there were some underlying fiscal issues are being disguised. This is the federal debt held by the public as a share of our annual national income. And what you can see is a significant rise in that recently. This is one subset of that, looking at Social Security. This is the combined trust funds, and as you can see, they will be exhausted by the baseline estimate from CBO out here in about 2030, according to their current projections. So without reform, and Social Security is actually the easiest one to fix. It's a function of where you set the retirement age. Medicare and Medicaid are much more difficult, and those are issues that are not being dealt with by Washington at this point. The fact that interest rates are very low means that the burden of that debt is actually a lot lighter than it would be were interest rates on a more normal profiles. So what I've done is divided here by the Social Security, major healthcare programs, other non-interest spending, which would be things like defense and discretionary spending, and then net interest. So, and divided total spending among those things. And as you can see, the things that are growing are the entitlements and also the interest expense component. So failure to reform those entitlements will do one of two or three things. It will either force significant tax increases in tax revenues, expenditures cuts on the non-entitlements, or the entitlements will have to be addressed. And there's a point at which you cannot generate more revenue without actually stopping economic growth. So that's a national discussion that is hopefully coming. Whoops, I went too far. All right, so let me turn to housing for a few minutes. So with that backdrop, again, our view of economic growth this year, about 2%. We think the same next year. We don't really see anything on the horizon without a change in monetary and fiscal policy that would accelerate growth. So we make the assumption that policy stays fairly static. That suggests, in that background, housing moves basically with demographics. So it has good long-term prospects. Employment growth has picked up. Household formation has picked up. That increase in demand opens the door for increases in supply, but it's not normal. There has been a structural change in the cost of developing housing. There's also been a structural change in the cost of financing housing, and those affordability constraints are starting to call for action in terms of policy. And that's some of the discussion here in Sarasota. I read a couple of the newspaper articles about the access to affordable housing. That's actually a national discussion. Sarasota is just joining what has become a national discussion. If you take, for example, someplace like Silicon Valley, I was in San Jose about 2 weeks ago, and there is no supply of low-cost housing. The total supply of housing in that area is about 2 months' supply. Normal is between 6 and 7 months' supply. So houses that are getting between 10 and 20 bids and almost always selling at above the asking price. Rentals, apartments there, charge monthly rents for pets. Huh? So I tried to move the family out there. We have 5. I thought maybe a pet reduction strategy. The family didn't buy into that. But that gives you just an indicator of how tight the housing market is that you can actually charge monthly rent for pets. So let's take this apart just a little bit. So we've seen, here I've given you a little different measure of employment. This is the employment to population ratio, so not working age, but just total population. We've seen that start to pick up. A part of that, in our view, is demographics. Part of it is the business cycle. We came out of a recession. Employment has definitely picked up. And that pickup in employment has led to, in the 2015 time frame, a big burst of household formation. Now, a couple of years ago, I think 2013, we had the highest share of adult children living at home ever recorded in the census. So we surveyed the parents of those children, and we asked them, do you love them? And if so, for how long? We didn't phrase it exactly that way. And we didn't survey the children because we didn't want to start the fight. But we found a couple of very interesting things. One is, of those, we divided the children between those aged 22 and below and those from 23 to 34. We thought we would see a significant difference between the parents of those two groups, and as it turns out, it wasn't very different. 70% of those with the 22-year-olds and below were quite happy with them living at home. They expected them to be there maybe up to 5 years. Those 23 to 34 parents, 63% were quite happy with them living at home and thought somewhere closer to the 2-year time frame. When we looked into the reasons for those attitudes of the younger households, we're speaking at a college, in many instances, the pace of college, the cost of college has risen something like double the pace of inflation over the last 20 years. So in a recessionary environment, the kids were going to college and living at home to cut costs for going to college. That's a pretty rational strategy. For the older cohort, a significant share of the parents had suffered financial damage, and those older children are actually making a contribution to household income. So we hadn't realized or hadn't really thought through that potential family impact of the recession and the response of households to that. So that was kind of an interesting learning, and we started to see that unfold in 2015. We think that we will continue to see that, perhaps not at the pace that it happened in 2015, but we expect that to continue to happen. So I said housing is not normal. So here's, if someone claims that to you, here's a picture that you can use to discount that argument. What we've done here is put the ratio of new construction per 1,000 households over time. So what you see is today, this is where we are today in terms of that ratio of production, which is at just the very trough of the prior 2 recessions. So housing production is nowhere near what would be suggested by our population. Very significant. That's what's leading to 5 to 6% annual house price appreciation. And I don't think I have the slide in here, but we went through the top 20 metropolitan areas, and we divided the house prices in each of those areas into 3 groups, low, medium, and high. And then we looked at the pace of change of price, low relative to medium and low relative to high. And in only one market was the lowest price, not the fastest rising in terms of price. So those new households that are forming when they enter the new home market typically enter at the low price point, but there's simply no construction at the low price point. On the right-hand side, this is the construction of apartments. During this time period, 1995 through 2005, for every new household that was formed in the United States, one became an owner. So the construction of apartment buildings was flat during that entire time period, simply replacing obsolete properties and growing relative to the population. There was no expansion in that space. Then the drop-off in the crisis, as you can see, that's accelerated past that flat period of 95 to 2005. That's because of the readjustment in the homeownership versus rental share of our population. So homeownership rate peaked in June of 2004 at about 69%. I think it was 69.2%. Today it's 63.5%. So we got well ahead of ourselves in terms of the share of the population owning homes. We went through the crisis, which was a very wrenching adjustment of that, and now we're back to what is more of a normal relationship between owning and renting. But because there was this reduction in demand for renting, which is now showing up, the apartment building business has been going very strong for the last 4 years or so. We think that now that the millennials are moving out, more of them are becoming first-time home buyers, we're going to expect to see the construction in the apartment space slow over the next 3 years. But there is a relationship between the lack of low-priced single-family homes being built and the rental market. The vast majority of the rental apartments being built are high-rent apartments, Class A properties. And owners of Class B properties have been rehabilitating them and moving them into the Class A category, and no one's building Class C apartment buildings. So when those households form, if they first become a renter, they're paying a rent which is higher relative to their income than would previous cohorts have paid. To the extent that they want to become an owner, that slows the pace at which they can accumulate savings in which to become an owner and delays the time until they enter home ownership. So there is this relationship between both sides of the housing market, owned and rented, that has to do with low-priced properties. That's why you're seeing the discussion that you're seeing in Sarasota. That's the same discussion that's taking place in almost any metro around the United States. So the question is, why is that? Why is the supply function not working well? So that if you talk to builders, this is what they will tell you. The number one issue they faced in 15, which is even greater in 16, is the availability of labor, particularly skilled labor. So I'll give you a little insight into how Fannie Mae Board of Director meetings go. In 2012, the Fannie Board in January asked me, "Why are you such a pessimist?" So they were looking at our forecast for housing starts. And our forecast for housing starts was the lowest forecast in the consensus forecast. We expected about 950,000 units of construction, single-family, multifamily, and manufactured housing. The consensus forecast was between 1.1 and 1.2 million units. So they were wanting to know why we're such a pessimist. So I said, well, I grew up on a dairy farm in western Minnesota. And people would ask my father, Charlie, are you going to have a good crop of corn this fall? And he would usually respond, the thing that has to happen to have a good crop of corn in September or October is the tractor has to start in March. So we had gone from building 2.2 million units in 2006 to 600,000 units by 2008 and stayed there for about 3.5 years. So all those people who manufacture plywood and PVC pipe and nails and electrical conduits and hire the people who build those things didn't just let those workers sit there. They laid the workers off because business fell off, and they slowed their production processes. All of that was going to have to be rebuilt to get to 1.1 or 1.2. So our model said the same as everybody else's. It said 1.1 or 1.2. But a model is simply a complex averaging through past data, and if no such experience existed for the model to draw on, it couldn't possibly be right. So we said, let's make an educated guess on how fast people can ramp up production. And we called a bunch of producers in these different segments of the supply chain, and we guessed 950,000 starts. As it turned out, the total starts that year were 925,000 starts. So even though we were lowest in the entire forecast pool, it ended up being lower than we thought. So what the builders are suggesting here is they're still looking for that labor to come back, labor which exited. Much of it actually went home. We were looking at immigration data, U.S. versus Mexico, because there was a lot of Hispanic labor in the construction space. And what you'll see is actually, irrespective of what you're reading in the political headlines, in the last 5 years, there has been more net outmigration to Mexico from the U.S. than there has been in-migration from Mexico into the U.S. That is not well understood publicly. Although it is Washington, so you don't want to confuse them with facts. This is why Fannie Mae makes me put this disclaimer in here. I view I-495 sometimes as a wall against reality. That's the freeway that goes around Washington, D.C. But I'm just a farm kid. What do I know? So the labor, access to labor is one issue. The other issue is... I didn't put land. Did I put land? Yeah, here it is. Cost and availability of developed lots. Now, I've been in 9 major metropolitan areas in the last 4 months. And in each instance, I talked to people who invest in land and develop it to the point of construction. So land developers. And I asked them about the regulation related to land access and development, and the pre-crisis versus post-crisis cost. And the range of answers I got was the increase was between, in every instance, every of those 9 metropolitan areas, that cost had increased, and their assessment of it was between 20 and 50% increase, depending on which metropolitan area they were in. So going back to the story about where is the low-cost houses, first of all, if you've added 20 to 50% to the cost of the land, and you've had to raise wage rates to attract labor, which wage rates in real terms now in the construction space are as high as they were at the peak before the bust. Those are 2 cost components that go into building your houses and the minimum price at which you can profitably sell a house. So you start to see the compilation of effects of the crisis on why supply at the low price points is not where you would think it would be, given the ramp up on the demand side of the equation. So the failure of supply to rise is the thing, in the presence of rising demand, is the thing that's pushing prices up, which goes to that little anecdote I gave you at the outset about people now starting to do cash-out refinances again. So here's what's happened on the mortgage side. I was talking about building the buildings. Now, of course, the builders, in many instances, are dependent on people to provide financing because the majority of people who buy a house use a mortgage. So what's happened here is this is the direct servicing costs, or the costs of the people who collect the monthly payment because of all the response to the consumer protections in the crisis period. So a huge increase in costs, almost a tripling of the cost of the servicing component of the mortgage business. And this is fully loaded production costs. So on the production side, about a $2,000, $1,500 to $2,000 increase in the cost of producing a mortgage. So if both production and servicing costs have risen, reasonably you would expect there to be either an increase in the cost of mortgage credit or a rationing of mortgage credit, and both of those things are actually happening. So if the minimum size of mortgage that can be made profitably doesn't match up well to the size of house that you would want to build, that's another burden about that's in front of ramping up production of lower cost housing. That makes sense? Those things should, hopefully they hang together logically. Now, with interest rates being as low as they are, affordability is still quite strong. Of course, you'd have to qualify if you're using a mortgage. And there's no question that credit conditions have tightened. Now, they've eased some recently. We actually survey, in addition to surveying 1,000 households a month, we decided to start surveying mortgage lenders. The only data that was out there on mortgage lender attitudes previously was the Fed's survey of senior bank loan officers, which tend to be heavily weighted toward large banks. And actually, the majority of mortgage lending is now done by non-bank institutions, mortgage banking companies, and they're typically much smaller. So we started surveying them on a quarterly basis, and we've asked them, first of all, we asked them, are you planning to ease credit conditions? And they said yes, and they have done that. They said they were going to, and they have. Not a great deal, but there has been some easing. Acceptable loan-to-value ratios have risen. Acceptable credit scores have come down. Not precipitously, but they've made progress. But then we also asked them, do you have constraints on credit qualifications that are above what Fannie Mae and Freddie Mac require? And 40% of the market has constraints above what Fannie Mae and Freddie Mac require. Now, why would that be the case? Well, if you have to answer to shareholders, and those shareholders have seen you pay billions of dollars of penalties to the Department of Justice or to another regulatory agency, what you don't want to do is go back to shareholders and say, once again, we've gone too far. So they are staying within the boundaries, particularly, again, this is affecting lower income households because typically they have less rich credit data on which to draw conclusions about their credit qualifications. So the credit piece fits with the housing supply piece, and that's why you're seeing the headlines that you're seeing. This is the relationship between the house price and rentals. Rents. And it's intended to show that house prices are appreciating even faster than rents are appreciating. Now, somebody pointed out to me the other day correctly, I actually need to change this and put the mortgage payment on here as opposed to the house price. And I think that's a valid consideration. So I'll rework that. But it is the case that house prices, by various measures, are appreciating faster than rents are appreciating. See if I can, there we go. Okay, so let's move. As I said at the outset on our forecast, 2% growth. Mortgage rate's going to be roughly at the end of the year where they were at the beginning of the year. Increase in housing, about 3% sales this year. Last year, home sales increased 7% over the previous year. So up again, but by a slower pace. A lot of that simply because there aren't available properties for people at the low price point. All right, so here's the housing policy objective questions. There really isn't a well-defined objective for U.S. housing policy. People have different things in their head. There's a push to home ownership. Both political parties have supported that over the years. There's today a questioning about that. Our surveys of millennials suggest they have a very much more healthy attitude about homeownership, that you not only have to have the resources and characteristics in place to acquire the home, but you also want to maintain that home. And so they're being more conservative about approaching the market than were some previous generations. Interestingly, though, they have appreciated the fact that home prices fell dramatically. They are the group, if you divide by age group, who has the most optimistic view with regard to the investment potential of housing. Now, that really depends on where you live, because house prices change a lot and differently between different geographies. But it is interesting that they have a strong view of the investment potential of housing. So what's the right homeownership rate? These are the questions. I've got a little bit of data about each of these. How much competition is the right amount of competition? How much risk should taxpayers take on? Because, as you know, the GSEs, Fannie Mae and Freddie Mac, are still ultimately a contingent liability of the taxpayer, as is FHA. And what are some unfinished policy items in real estate and real estate finance? And then I do want to talk about the future impact of the Federal Reserve on retaining or releasing mortgage-backed securities. We've met with Janet Yellen and some of the other board members a couple of times in the last couple of months. Interestingly, the one question she asked and probed on both times was, why is the housing supply function not working properly? Right? So I'll talk about that in a little bit. Here's where we are in the U.S. homeownership rate. This was the peak that I was talking about in 2004. We got way ahead of ourselves. Obviously, a lot of that was unsustainable. People not only got mortgage products they didn't understand, but they also stretched financially beyond their means. This is what happened with credit scores. You would have seen credit scores about 50 points lower than this. And you would have seen loan-to-value ratios another 10 percentage points or so above that. So there's been a significant shift in the underwriting criteria. That's been a contributor to why the homeownership rate has made the adjustment that it has. If you look at our book of business, the mortgage loans that we've put on since 2010, very little delinquency in that, very pristine performing loans. And as I said, we're actually willing to take on more risk than lenders are willing to send our way. About 40% of them don't reach the boundaries of our metrics. There's a discussion that's been underway about, and I know that's way too many numbers. This is for in the event that you're having difficulties sleeping or whatever, you can kind of work through these. There was a discussion about how many missing owning households there were. And some folks have suggested they're in the millions. So what we did was we went into the demographic data and we looked at households by 2 or 3 different metrics. First of all, we looked at their credit characteristics. Did they have the credit scores that would allow them to qualify for mortgages in today's world? Second, we looked at, do they have savings? Do they have about $10,000 savings, which is a reasonable number across the country that you would have to enter the mortgage space? And then we looked at their income relative to median house prices in the community in which they lived. When we passed it through those screens, we found there are about 600,000 renters in the United States by those criteria that would be qualified. So the suggestion that there are millions of missing homeowners is really not, from our perspective, an accurate assessment of what's out there today. Now, that doesn't mean that there won't be millions going forward. I showed you the demographic profile, which is very strong for the housing market going forward. But if you look at the millennials today, or let's take the 25 to 34-year-old age group, if you look at their real income, it's about $8,000 lower than that same age group's real income 10 years ago. So they have still not caught up financially to where their age cohort should be relative to past groups. So while we think ultimately the homeownership rate will come back up a little bit, if we had to pick a number, we would say somewhere between 64 and 65% is probably the long-run homeownership rate. And right now we're at about 63.5. But it's going to take a while for those millennials to pull that number back up. Now, in the In terms of competition, one of the things that we're seeing at Fannie Mae is the regulatory and legislative response to the crisis has led to a reduction in the appetite of large financial institutions for mortgages. So the share of traditional banks has dropped off from about 66 down to 51%. And in Fannie Mae's business, if you went back to 2009 and before, you'd have seen that the top 10 lenders would have represented over 70% of our business. Today, that's less than 50% of our business. Huge drop-off of the contribution of large financial institutions. The rise of small institutions it has replaced that. So there is a question of whether or not that is a permanent structural shift. And I would suggest it is not. We're going to see some reconsolidation. The reason for the reconsolidation is those cost curve pictures that I showed you earlier about the rise in servicing and production costs in the mortgage space. Most of those are being driven by the response to regulatory compliance. So for example, I had breakfast with a mortgage banker who his company produces about $1 billion of mortgages annually. He had taken the compliance staff in his company from 3 to 33 as a response to the change in their regulatory environment. They changed the structure of their company in order to survive because of the change in the cost structure. And then volumes dropped, the refinance volumes dropped off, which meant they had less business throughput. So they're worried about surviving another 18 months. So those small firms in the period when policy has advantaged refinancing and held volumes high, when that drops off, then we expect a number of these small firms are going to go out of business. When I was flying to Washington, D.C. this week, I went through the Atlanta airport, and the CEO of a mortgage company who knows me saw me walking by, and he grabbed me, and we talked for a couple of minutes. I asked him what he was doing there. He was there. He's in, say, about the 25 to 50th percentile in terms of size. He's buying a company that's in the 50 to 75 percentile. He was there conducting an acquisition at that time. And I asked him if this was his view that, in fact, the market was going to reconsolidate. His answer to that was yes. So fewer lenders, less competition because of the rise of regulatory costs within the industry. Now this gives you an idea of, I'll assume I'll give you 1 minute to take, well, maybe I'll explain this a little more. What I've done here is divided by the number of lenders. This is 2011. This is 2014. And what this means is the range of risks that companies are willing to take by size of company. These are the smaller companies. So what you see is smaller companies are bigger risk takers, which means that the window for borrowers to qualify is wider for them in smaller companies. So the consolidation is likely to take place among the smaller companies, which means the band of opportunity is going to narrow for consumers. And it's because of the regulatory compliance costs that they will have to bear. And the larger firms have broader scale over which to spread that regulatory compliance cost. Right, so then I said that one of the topics was how much risk should taxpayers bear. Obviously, that's a reference to Fannie Mae and Freddie Mac, as we are, after all, still a contingent liability on the public balance sheet. And we have about $3 billion right now of capital. A private firm with the scale that we have today would probably hold over $100 billion of capital. By the end of 2018, by regulatory agreement, we will have zero capital. So we're shrinking our portfolio, and we will exhaust our capital by the end of 2018. So the question is, What do you do about that if Congress and the White House can't make an agreement on how to reform the secondary market? So this is the shares of the different institutions: Fannie Mae, Freddie Mac, which basically were very similar kinds of firm; Ginnie Mae, which is the company that securitizes FHA loans and Veterans Administration loans; and then private label securities. As you can see, this was the run-up in the mid-2000s of the private label security business, which has essentially gone away. It is no longer. And what has happened is Ginnie Mae has actually been the largest growth factor recently. In fact, the mortgage securities issuance of Ginnie Mae has been bigger than Freddie Mac every month for the last, I think, 8 months. And in several of those months has been bigger than Fannie Mae. That's a result of 2 or 3 things. One, the first Gulf War veterans and now the second Gulf War veterans are a very large group which are not burdened by student loans, for example. And so Veterans Administration lending has been the biggest growth in the Ginnie Mae portfolio. FHA also has a streamlined refi rule which allows people who have FHA loans and certain characteristics to very easily refinance those loans. And they cut their mortgage insurance premium. So all of those things have moved business from Fannie Mae and Freddie Mac to Ginnie Mae, which is a government-owned corporation, has been for a long time. So they've picked up share at the expense of Fannie Mae and Freddie Mac. Now, our portfolios at one point were well above our Fannie Mae's portfolio was about $1.5 trillion. Now it's down to about 600,000. By agreement with the Treasury, it will be 250,000 by the end of 2018, and the same thing for Freddie Mac. When I get to the discussion of the Federal Reserve, you will see that the Federal Reserve has taken into its portfolio all the reduction of Fannie Mae's portfolio and Freddie Mac's portfolio and additional mortgage assets. Whereas prior to the crisis, they had never held a mortgage asset. So that's a public policy question as well. What we're doing in response to the reduction requirements in our portfolio is we're issuing a new kind of securities where we share the risk with private investors. So part of the risk in the mortgage space is held in bank portfolios. So banks have been increasing their holdings of whole loans or mortgages, mostly at the upper income categories because they also cross-sell investment advice to those households. So they have a cross-sell motive to increase that portfolio. Then in the shared risk, this is the new kind of security that we're putting out there. A question there is when we are restructured, whether policymakers recognize we now make this market. It wouldn't exist in our absence. So if they restructure us, they should make note of whether or not they're going to strand these assets in the marketplace. This is the GSEs, the risk that the GSEs hold, and then Ginnie Mae at the top. Also sharing in there are private mortgage insurance companies. But private mortgage insurance companies largely exist because of the rules related to how much lending we can do relative to the price of a property. So the Federal Reserve. I thought you'd be interested in the genetic relationship between interest rates. And so this is Paul Volcker. He was 6'7". Interest rates are very high. Alan Greenspan, 5'11". Interest rates fell. Ben Bernanke, 5'8". Janet Yellen, 5 feet. So a lot of people were unaware of the genetic relationship. Oh, that's interesting. That's not what that's supposed to look like. We're missing some slides here too. Okay, well, we're missing about 5 slides. So if you look at 1-year U.S. Treasury rates, subtract the inflation rate, what you'll see is that interest rates have been falling for 35 years. And in fact, in real terms, for the last 6 years, U.S. 1-year Treasury rate interest rates have been negative. So the discussion of negative interest rates has a number of different aspects. I won't spend a great deal of time on that, but I would suggest to you that if you think about the housing market and the reversal of that, there are probably some challenges that are going to be faced, particularly if we don't see a significant pickup in income. For example, in the crisis with all of the delinquent properties, there were a couple of public programs to allow for the refinancing of those or the reamortization of those. We were able to do that because it was a declining and low interest rate environment. When the posture of interest rates moves the other direction, it will be much more difficult to recast those mortgages and make those households successful. As I mentioned, the Fed is now the single biggest holder of mortgage-related assets around the world. So the question is, what happens when they decide to release those mortgage-related assets? And if you read the Federal Reserve meeting minutes, I assume you read them. Not sure what you people do with your lives. Economists read them and then they discuss them at cocktail parties. That's why you don't want to go to economist cocktail parties. One of the things that we wanted to have in the conversation with Janet Yellen was to make sure that the Fed was thinking about the fact that when they did make that decision, which I'm sure they were, but we wanted to know if they had questions about that we would not be buying them back. So if you look at the history of who holds the mortgage assets, the mortgage-related assets, it was in the 1930s, it was insurance companies. With the growth of the thrift industry, it was savings and loans, which had a charter requirement that they hold them. Then when the thrift industry died, it became Fannie Mae and Freddie Mac. And now that Fannie Mae and Freddie Mac are constrained, it's the Fed. The question is, who is it after the Fed? Because the Fed is a policy buyer, not an economic buyer. In other words, they're not buying because of the yield on those assets. They're buying to affect interest rates in the broader economy. So what we don't know is when the Fed exits from that, who will buy and what rates and spreads the market will reveal in that time. And we would expect perhaps an upward posture for interest rates, which is likely to have some impact on housing. So the last thing that I said, and I'm not going to spend time on this because I would like to take questions, was other reforms that were needed but not done. So reform has not fixed the adverse incentives in the rating agency business. There was a great deal of discussion during and after the crisis on the adverse incentives there. The tax incentives in residential real estate remain unaltered. So you think of the mortgage interest deduction, you think of the capital gains treatment. Those things have not been dealt with. I'm guessing, given the fiscal posture of the country, that there may be some discussion of those. The differential in treatment between first and second mortgages. In other words, if Fannie Mae guarantees a first mortgage and after that borrower takes out the first mortgage, they then go and take a second mortgage. It changes the risk profile of the first mortgage, but it's uncompensated. And in the crisis, what you saw was there was a significantly different treatment between first mortgages and second mortgages. So that'll have an impact on who might want to participate in competition in the secondary mortgage market. It's very clear if you look carefully at appraisal data that appraisals are biased. So the question is, should that be addressed? And what are the implications of that? And then, as I said, failure to reform Fannie Mae and Freddie Mac leaves the taxpayer with a contingent liability, which is not currently being priced. So with that, let me end there and take questions that you might have. Uh-huh.
With the Fed buying the student share of the mortgages, have they structured their offsetting? In other words, have they gone long enough that they're not really at risk of really structured their own borrowings out long enough to be able to hold these mortgages?
Well, I should probably ask Bob Eisenweiss to answer that. I've been following his work on the duration of the Fed's portfolio. I don't think that's actually a relevant question. They can hold essentially what they want. They can expand their balance sheet to any extent that they want, or at least to this point, there's been no side effect of that expansion affecting them directly in terms of their ability to borrow.
But isn't that because rates are low?
Well, that's part of how rates are as low as they are. I mean, that was part. The objectives of monetary policy with regard to housing were two. One is the assumption is that house prices are autoregressive and mean reverting, meaning if they overshoot on the upside, they will overshoot on the downside. So the Fed was conducting monetary policy to put a floor under house prices because rising house prices generate a sense of greater wealth at the household level, which feeds back in some small proportion to consumption. So they were attempting to stabilize house prices by putting a floor under them using monetary policy. The second thing they were attempting to do was to lower rates to give households the ability to refinance and improve their financial profile, lowering their debt servicing costs, which would be a second way that they could assist households to increase consumptions. So they had two primary objectives, which led them to take actions to drive interest rates lower. So that was a stated objective.
Earlier, your slide showed the disconnect between the price of housing, and the fact that the renting levels had not been keeping up. How do you see that playing out going forward?
Well, we've seen the early signs of slowing in rents, but we think it's largely because the higher incomes renters have the supply there. Has largely met demand in such a way as to slow the pace of rental appreciation. The question is, will you see an expansion at the low end that is the supply of low-priced rentals? The house prices have the same dynamic. They've been appreciating, and partly because of the lack of low price supply. So. Let me extend your question just a little bit and ask, do the changes in the profile of rents and the change in rents and in house prices imply that we could see a flattening or even a decline in house price if the supply function picks up? The answer is yes. We would expect, if supply picks up, that gradually both rents and house prices would slow in terms of appreciation. One of the things to keep in mind is there are institutional investors who entered the market opportunistically during the crisis and hold a significant supply of rentals. In the event that the house prices slow and they have a return objective that includes both capital gains and cash flow in their returns, and they see the capital gains piece slow, they may well decide to put those properties back into the market. And in selected markets, that action could bring at least temporary price declines.
Would you address the potential government role in increasing productivity, which, according to your graph, is extraordinarily low, and that of the low qualification rate for those who apply for mortgages?
Okay, let me take the second part first. Of those who are applying for mortgages today, a higher share of them are actually being approved. So what's happening is people who either are not qualified or believe themselves not to be qualified are not applying. So the share of people who apply contains more people who are likely to be approved, and so the approval rate's actually higher of the flow. But it's a discouragement of people who might previously have applied that's leading to that. That ties back to the productivity question, in that they may well not be applying because they haven't seen growth in their incomes. My personal view is there's a very clear relationship between business fixed investment, worker productivity gains, worker income growth. But the current posture of monetary and fiscal policy suggests the business community is better off dealing in financial sector issues, things like stock buybacks, which are not investments in plant and equipment, and therefore don't drive productivity gains. And my view is, until monetary policy moves toward a more normal posture, businesses are intelligent to be in that space. Plus, there's not really anything on the fiscal side that has increased the probability of growing profits, in that there are significant tax issues faced in the business community, which there's a lot of discussion in Washington about tax reform. I think actually both parties know it needs to be done, but nobody has kind of gotten together to figure out how to get that done. Enough economics for one evening, I think.
Please thank Doug.
Thank you.